We would like to move to the next session. That would be Neobanks winning over MSMEs. The session would be moderated by Mr. Abhinav Nayar from Mool, and our panelists are Mr. S. Anand, PaySprint, Mr. Vishal Gupta, HyLoBiz, and Ms. Avisha Gupta from Luthra and Luthra.
Thank you for joining. I think this session conflicts with Mr. Piyush Goyal speaking upstairs. So we know everybody in this room is a diehard fan of neobanks and MSMEs or some part of that. My name is Abhinav Nayar. I run a company called Mool, which is a digital financial services and data platform winning new to digital users. And I'm really excited to be joined by our esteemed co-panelists here. Would you like to introduce yourself, Avisha?
Thanks, Abhinav. So I'm Avisha Gupta. I'm a partner at Luthra and Luthra in the TMT practice. That's what we call this space. It's called Telecom, Media, and Technology. What I focus primarily is tech, and of course, fintech forms core practice area in the technology area right now. So other than fintech, there is a good amount of focus on data privacy, health tech, OTTs, and a host of other emerging tech related spaces. So very, very exciting space to be in, and look forward to this discussion. Thank you for having us today.
Hi everyone, good evening. My name is Vishal, founder HyLoBiz, now part of Vyana. We merged with Vyana Networks last year. Been a serial hustler for past 2 decades, 6 startup, this is what it was. And this one happens to be in the fintech space, kind of shy away calling it neobank, while we are calling the whole panel discussion to be around being a neobank discussion. Supply chain focused, largely B2B within the SME ecosystem, solving some of their day-to-day trade issues, but ultimately all of us want to get to the holy grail of providing capital and credit to these guys. So that's the journey where we are. Operational in 5 countries, this particular startup right now, HyLoBiz, around 300,000 odd SMEs on the platform who use the platform, and a few more things which we'll talk about what we solve for them in terms of various day-to-day challenges. Thank you, and happy to be here.
Hello. Yeah. My name is Anand. Good afternoon, everybody. Happy to be here, part of the panel. So PaySprint happens to be the first startup. I turned entrepreneur 2 years back, and we're trying to build up an entire B2B API stack, basically focusing on completely on an infrastructure play. And that's what we do. 2 years of exciting journey, and happy to be here. Thank you.
Great. So let me start with a quick story. As a first-gen entrepreneur, I didn't realize that when you start a company, you needed a current account. But being a fintech founder, the first thing I did was go to one of these new banks, right, and created an account for myself. I let them know that this is the account I'm going to receive some capital in these days. As soon as they saw an 8-figure deposit, the account was frozen. And it took me about 3 days of wrangling and some angry messages on LinkedIn sent to their leadership to get that money back. Now, before I could get it back, I had to open a current account. I went to a private bank, and they told me I need, a trove of documents, including a board resolution. I got all of that together, signed them all, and then the bank said that the one thing you don't have is a rubber stamp. And I really wondered at that point why this rubber stamp that just has the company name can be availed by anybody for about 200 rupees in 20 minutes is somehow verifying the authenticity of this company. It obviously didn't help that I was walking around the bank branch in shorts, being the director of the company. So, we've had both of those experiences, right? We've seen technology companies partnering with banks, offering differentiated, better solutions. And we've seen, this was 2 years ago, and in that time we've seen banks also evolve their business offerings, right? And I guess when you think about the needs of a small business, right, you're trying to solve for convenience, capital, and growth, right, which is what a small business really needs. So Vishal, let me start by asking you, how are you looking at that convenience aspect?
Yes, I guess as an entrepreneur, and even if it was to be solved for you when you was opening your current account or any of our challenges out there, the problem that I guess we really need to get down to is, does that really move the needle or make an impact in this SMEs or MSMEs life? I mean, typically at a very high level, right? If we were to look at capital, for example. So, of course, there are possibly 100 guys out there who can lend capital. Someone can do faster, someone can do slower. Rates could be different and all of that. We kind of really need to get down to a level wherein what kind of capital, what kind of product, what is the nature of this guy's business, right? Does he needs capital every 5 days, 10 days? When does his DSO cycles come through? What his typical collection cycles look out to be, what his payout cycles look out to be, and what level of or what kind of scale of capital would he need. So more like, more than convenience, I guess, to identify that one must have to begin with, and of course there could be 5 other must-haves which can come through. So from that perspective, I guess the way we looked at the whole SME, MSME space, and the whole world talks about it, and we sing the same song. We call it 4 C's. So solve for cash collection, solve for their commerce, solve for their compliance, and solve for their credit. And this is, again, very high level gyan which all of us give. But now within each one of these C's, one really need to figure out, based on the segment and the category that we go after, that what, maybe linking back to Abhinav's point on convenience, that what is that problem which I can make it so convenient for this guy, then other pieces can. So call it from a business perspective, we are looking a hook to penetrate the market and make something very sticky, as how our VC friends would like to hear what is sticking there and what is the hook there. But I guess that's the key, right? To be able to identify if it is capital, what size, what color of capital, if it is compliance, GST down to 5 crores in April, is that something which can become a hook? Cash collections, can I help with the feet on street or with the digital payment links to collect this guy's money faster? Or something similar to ONDC equivalent, the ecosystems which are falling in place to enable commerce. But I guess one thing that remains is to find that one unique hook or key which makes a difference for this guy's day-to-day trade. And the way we look at it is find that hook, become part of his day-to-day business, day-to-day trade, even before you spoke anything around banking. So it's largely tech is what we keep talking and keep selling. And the day we feel that one of such hooks have settled in very well is where essentially we start opening any discussion to do with the fin side of it.
So that's really insightful because while on the one hand you're looking at building product that solves problems for the entrepreneur, such as their receivables, their invoicing, their payroll, and make that easier. By doing so, you're also making that business more legible, right? And understandable by other entities, including capital providers.
Yeah, absolutely. So I guess data is what everyone is looking at, and especially the segments and the smaller businesses wherein we don't really have organized data. There are no structured ERPs at that level. There are no compliance data which is available. Banking could be very minuscule part of their business which where the money is actually traveling through the payment rails. It could be all cash and check, but thankfully of late there could be a lot of UPI and the QR codes out there. But yeah, I guess all of this is where which now kind of becomes the basis of a lot of new entrepreneur friends who are onto the cash flow and transactional based products and the financial services offering.
Right.
That's true.
Right. So Anand, let me turn to you. You just heard the value proposition for why technology companies should edge their way into financial services. What do you hear when you take this proposition to banks and say that, let us build the infrastructure that makes all of this possible? And how do you defend, their need for distributors and a distribution layer or a third-party layer to a regulated entity?
Well, I think rightly said. I still remember, let's say about 5 years back, whenever you used to walk into a bank to talk about technology, about what you're building up, you would probably, you probably will not get those solutions, or you probably, the understanding was an issue always, trying to understand what we're trying to build up. Thankfully, I think a lot of things have changed post-COVID, and what I realized is that from a bank perspective, who probably was looking at fintech as a competition, probably now looking more as a partner. So I think that the change in perception, the change in the way a fintech is looked at has really changed, especially in the banking ecosystem. And I think today the discussion, obviously, rightly said, is more how can you help us to, how do we work together to, let's say, distribute our products or take our products? What's the value add you'll be able to do on the products we offer you? And how will you really be able to ensure that it adds much more value to both existing as well as new partners, right? New customers. So from that perspective, the banks have started looking at fintech very, very, seriously. The level of discussion, level of tech integrations, the level of tech discussion of the bank is at a much deeper level now, right? And the banks are ready to look at you, hear you what you want to do, and also support you, obviously within compliances and within regulations for sure, but at least the experimentation part is always there. So I think there's a huge change in what's happening on the banking perspective.
So I think having this conversation today is a little different from having it in 2019, right? Because over the last couple of years, we have seen some, so-called neobanks get to scale. I think the results of that is still being worked out, right? But at least at our level, we know that, okay, I think 2 of the market leaders have spent about $100 million over the last 2 years to gather about $100 million worth of deposits, right? And Avisha, let me come to you with this question now. So a couple of years ago, it was easy to make this argument to banks that, okay, as a technology company, we have some time arbitrage. As a bank, you have a regulatory arbitrage. This seems like a win-win partnership, right? But how do you see, in the context of Indian law and policy, the thinking moving forward for us to be either, take up something like Niti Aayog's proposal for digital bank licensing, or do you see a brief continuation of this business correspondent model, or is there a third way?
So, interesting question, Abhinav, that you posed. I think the industry right now is almost on a daily basis contemplating on this question. This was also sparked off, apart from the business concerns, it was also sparked off from the Niti Aayog's discussion paper, which suggested a full stack license for a digital bank, which is not in place so far as per the current regulatory regime. I can dive a little bit into the current landscape so that there is context before I answer your question, Abhinav. There is a misconception that neobanks are operating in a regulatory vacuum. It's not the case right now. Despite there being no specific regulations around neobanks, neobanks are very much regulated through their partner banks. And there are guidelines, there are RBI's outsourcing guidelines, there are banking correspondent guidelines. Of course, all these guidelines were formed with a very different intent, were formed with a very different entity in mind. and which is why they are perhaps not keeping in line with the times or keeping in line with the kind of entities that neobanks have developed and flourished. But even today, to just set the context right, through contractual agreements, RBI as well as banks have a very close supervision of neobanks, be it in terms of monitoring, be it in terms of security procedures or audits. Even RBI has very much the right through the banks to undertake an audit or look at the books of account, look at transactions. That being said, what's lacking right now in the regulatory space is essentially a dedicated framework for neobanks, looking into the realities of the times, looking into how neobanks have forayed into so much more than just being a partner to the bank in their banking activities and say, for example, only account opening ease and conveniences around the digital banking side. And that's where the Niti Aayog's paper that had come up in July of 2022, that threw up interesting feedback from the industry, and I'm speaking basis our interactions with the clients on this aspect. And there are mixed reactions on both sides, to be honest. One view is that the only sustainable or financially sustainable way for neobanks to continue their business is to deepen their partnerships with not partnerships, deepen their banking vertical and become a fully licensed banking entity in themselves, undertaking all loans on their own books and doing everything that a bank does. This will, of course, have its implications a lot on the regulatory side, because this means there will be a new class of entities which are now acting as banks, and this throws RBI into a lot of discomfort in context of having this entire regime or entire set of entities which are now acting as banks. And in that context, the Niti Aayog has also made some recommendations around ensuring that these neobanks, whenever they are licensed as fully stacked digital banks, they follow the same prudential guidelines, they follow the same liquidity ratios, etc., which perhaps will not be easy to maintain. So now, just to wrap up and answer your question straight, Abhinav, there are both views. The other side of the view is that let us be technology players, because we don't do just banking services. In fact, getting into the banking service directly will make us foray into an area which is very different from what we are envisaging as our future. And remaining a tech player, we can really add value to MSMEs in the business side and also to retail investors. Because as Vishal really pointed out and highlighted correctly, these 3 C's that he mentioned about, they form the basis, they form the foundation for the 4th C, which is credit. Right? Once these 3 C's are really achieved, that's when one can look at credit. But I'm speaking on your behalf, Vishal, but I thought that was a very interesting thought. So there are arguments both ways, and we have to see how the industry moves forward in this.
I want to stay with you on this point for a second. So at Mool, we provide services that cover banking, investing, insurance, and soon credit, right? And there are 4 different regulators that we have to comply with, all individually, right? And our observation is that while the regulations are very clear from, let's say, manufacturers, right? The regulations in India around distribution are maybe need an update, right? Because if you're a registered investment advisor, your life is quite different from being a mutual fund distributor. If you are a banking correspondent which was a program basically to drive financial inclusion, that may not fit a high growth, high tech company bringing liabilities to a bank, right? So as this intermediary layer that wants to work with regulated entities on novel use cases, what have you heard or what ideas do we have to shift into something a little more systematic rather than being completely relationships driven, which is how even within banks these decisions about who to partner with and what to partner on get made?
Oh, so that's a tough one. That's a tough one, Abhinav. And before I begin to answer, I'd say there'll be a fifth regulator, which will be the Data Protection Authority, whenever that will come up, which will have its own line of laws, and we'll have to see how that interacts or how that intersects with the existing frameworks of SEBI, of RBI around data protection. But really, to answer your question around what's the way forward for having a more clearer regime in terms of different regulators at play, I would say practically it's an ideal thought to achieve, because for this to happen at the back end, all the regulators will need to align on a particular industry. And that's difficult for them because they see the industry in a very different way from their own standpoint. For example, the areas that RBI may be concerned with, SEBI may not be as concerned with, although the overarching vision or the overarching principles remain the same of consumer protection, confidentiality, etc., etc. But the lens that a regulator takes on a particular industry varies, and that makes it difficult for them to interact and come up with a solution which is clear for the industry. I'm not saying that's right or that's justified, but I'm saying that's how the practical reality is. Just to give an example, there was this whole debacle on the meaning of control. And control was interpreted differently by the RBI, differently by SEBI, differently by CCI, and it took a host of judicial decisions before they could come up with a clear framework. We really hope what we see as the next regulatory action around neobanks is something that covers for all these different streams playing parallelly, and they don't contradict each other, and they are framed in a manner which is more harmonious. Practically, this can be achieved only if the law is being framed by a representative of each of the relevant regulators, and thorough consultation process is taken with the industry participants, so that what we have is not just a law, it's not something that earns lawyers a lot more money, but it's something that really helps businesses in having a clearer approach to business.
That's great. I think our organizers have a new project on their hands. So,
in fact, Abhinav,
yes.
Just to add to what Avisha was saying, I think if you really look at, the entire, let's say, let me talk about the fintech space. It's been so robust, it's been changing so fast, right? I really don't think even, from the RBI perspective, to really understand what's really going to happen. I'm sure 2 years back, nobody knew what's going to happen with UPI, right? So suddenly it has changed the landscape today. We probably have launched with Singapore. So I think it's changing very, very fast. And in such a fast-changing environment, to create policies, I think takes time to understand the real implications. But what I really sometimes like what RBI does is that it gives you some rope to do, to innovate, to do your, tech solutions out in the market. And then when it grows to a certain level, probably then when they come back and say, let me look at the regulations and let me at least put some guidelines to it. So maybe, probably too early to comment, but maybe a right strategy to look at it. You don't know. So probably we'll get to know as you go across, but I think at this stage looks like maybe a right rope and give it some more innovation, then probably come back on it, maybe.
Yeah, I think whenever we're in trouble with our banking partners, the way we hear it as, there's still a lot of noise out there. It's not clear what we're not in compliance with, but it's the perception that needs to be managed. Vishal, let's turn to credit, which is an idea that you raised, right? Most businesses, especially MSMEs, have a predictable range of internal rates of return, right? Like, if you're a well-functioning MSME, you're probably doing about, say, 20 to 50% ROE, right? But the lending rates to these MSMEs almost, could eat all of that out. So how are you going to reduce the cost of capital in India with HyLoBiz?
Interesting. So I guess the only way to work that through is through the banking partners or the source of funds. There is no other magic one can think of unless if there are some people sitting in the room with some China connections and money coming through. But yeah, I guess sooner or later those all get arrested, and the channels get arrested. People still figure their ways out. So cost of capital very clearly, I guess, is one challenge across the whole supply chain that we serve today. Especially the segment that we start working with right at the, so in the whole supply chain pyramid, if you were to look at the top of the pyramid, look at super stockists, wholesalers, distributors, you know, or the regional brands and stuff. These guys typically operate within margins of 2 to 5% net is what is left for them. So effectively, from a rotation perspective, they can't really afford anything more than 1.5% if they were to rotate that capital on a monthly basis to let go. That's the worst case scenario. If someone was able to do it in 10, 50, 80 basis points, I mean, these guys would be jumping and actually borrowing money a lot more than they do today. And of course, grow with that capital. So the way we have managed to work through this model, Abhinav, so far is a couple of the partner NBFCs. So today as we operate, we work with 22 FIs in the country. This includes the largest public sector bank, the largest private sector bank, including NBFCs who specialize into certain segments, into certain verticals, and each one of these guys have their own niches and their own expertise with respect to the categories. They understand the risk appetite a lot better than even we understand with all the data sitting with us, because these guys have been with that business. So let's say some very small size NBFC that we work with in Surat, those guys understand the ceramic business back of their hand. And none of the banks and NBFCs would want to touch anyone doing ceramics because it's largely a cash business. So I guess that's the key to address, as in work with the right set of partners depending upon which segment are you going after. So today, give and take, we cater to 6 or 7 categories, which includes auto, chemical, FMCG, plastics, cement, some of the segments which many banks do not touch very well. But all that we have managed to do well is to get to the right financial services partner who's keen to work with this segment. And on our side, we have been able to, going back and touching the point on the 3C and the 4C. So from these businesses, we were able to bring data out of their ERPs, triangulate it with the bank, triangulate it with the GST servers, and all thanks to national infrastructure that we have today, wherein a lot of these APIs are available. We can pull this information, cross-refer, and tell this guy. So all that I can tell you is, I mean, as a business today, across the supply chain, we do $1.25 billion a month trade finance with 0 NPAs. We don't underwrite anything. It's all the banks who do everything, but we play our tech side of the role to enable the financial services. And I guess more and more such comfort continues. So when we started, Abhinav, the cost was higher, but I guess this cost has come down by a good 1.5–2% of each segment that we work with. But it has been a very gradual growth over the past 4 or 5 years for us.
So Anand, perhaps this is a pitch that you can take to your banking partners, right? When they say that, why can't we just do this ourselves, right? Do you think you can make the case for a 6% business loan supported by data?
Well, I think I'll tell you our own example, right? I mean, when we started PaySprint, we purely worked on offering APIs as infrastructure, right? And what we realized over a period of time that a lot of MSMEs who would come to us, small business would come to us and would say, I don't want to integrate, can you give me a platform to work on, right? And then we said, okay, you want to work on a platform, why not? Then we started putting a platform in place which had everything from collectibles to payments and everything put together. And it's a completely kind of a no-code kind of a platform available. And once we were doing that, then, things like, can you put invoicing, can we put all lot of analytics into it. So we started building up, the entire piece to just create that platform. But when we're doing it, and when the bank started seeing what we were doing, they actually came back and said, oh, this sounds good, and it's going to add more value. So why can't we be part of this, right? And we actually probably thought that we'll start with one bank, but today I think we have close to about 7-8 banks wanting to be part of the entire scheme that we worked on, right? And what we realized that they start seeing value in what we're trying to do here, right? From the bank's perspective, but also from the customer perspective, that he started seeing value. He said, I don't need to integrate, I just need to pick up and I just need to, I just need to log in. I just need to create my own login, and I can, get verified, and then I can start using the platform, with much more of ease of use. And along with that, whole set of other applications, whole set of, invoicing, all that all over the platform. So that is a big learning. I mean, we really moved in from just being a simple API player to be a platform player. And I think, and that was more from learning from what we learned from the market. And we found both the sides quite excited in what we're doing. So that's been our learning from the market.
That's great to hear. It sounds like things are moving in an optimistic direction. So we've covered most of the 4 C's here. Would love to open it up to the audience and take any questions that you might have.
Hi Vishal, thank you so much for a very interesting and enlightening piece. In fact, the question I have is specifically for you, because you talked about the cost of capital and how the cost of capital is kind of very high, and specifically for certain sectors, and one of the sectors that we are also targeting. So I represent a company which is into construction, material aggregation and finance. So the lot of conversations which we are having, let's say with NBFCs and financial organizations, the cost of capital is again a challenge for us also to bring it down to below 15%. While let's say on the data side, I have the data of my target customer. I'm doing all the hard work. I'm giving on the piece that I'm ready to take the hit. I'm going ahead with the FLDG model as well. But still, the cost of capital is a major challenge. How do you think that you should bring it down to a relatively sustainable number in the long run?
Yeah, I mean, I don't really have an answer to that, but I guess in the past few years there were some good times and a certain good window wherein players like us could play the FLDG cap, put some money on the side from our pocket and share the risk with the underwriter. That has gone away, right? So that's not something that you could play anymore. But now, I guess, getting down to, I'll tell you open book, I mean, how we operate literally, right? So we get our 10 success stories and 100 success stories in a given segment done. We work with one partner. And if there are any bankers in this room, please forgive me for this. But I guess it's all about banks hedging on us as all the fintechs, and there are hundreds of us who are working with the same bank. And the way, I guess, is fair for us as fintechs to look at the bank is to hedge with all, to date all the bankers right now, but finally find the right girlfriend for yourself that works. So get your success stories in place. Get your first sample set done, even if it comes at 15 or 14 or 16%. But those success stories, if you are sitting with a playbook, your conversation with the second and the third bank very quickly would be a couple of % down. And that's something which works for us today.
I think just to add to that, Vishal, I think one of the other things that banks could meaningfully do is create, MSME loans as a better regarded international asset class, right? There are parts of the world where capital is a lot cheaper than it is in India, right? And they're willing to hold on to 20-year infrastructure projects. There's no reason for us not to be able to get those very, same foreign providers of capital into a more active book. I think there was a question here.
Yeah, hi. So when I was looking at the topic, neobanks and winning over MSMEs, and look at the business model and the point you mentioned $100 million spent to source $100 million, right? You look at the basic business model, not just in MSME, but in consumer-focused neobanks. Is the discourse a little too focused around enabling payments and lending, or from a risk management, asset protection through insurance or other business streams have a play in that business model for monetization?
I'll take a stab at that. At least with respect to India, I don't know how fellow entrepreneurs in this room think about it. Software has no value. You will not get paid for software services per se. At least in the categories that I have operated over the past 3 startups, SaaS just couldn't get me any money. I go to my bank partners and I say, I will run it as a TSP with you, give you the whole technology. Bank refuses to give me money as well. But I have put my capital, I have borrowed money from outside, I need to make a business out of it at some point in time. And I guess sooner or later, we all start throwing the dart and the moonshot at the credit to be the holy grail to make money, which again, as a tech and a fintech entrepreneur, I would say that is not a space many of us even understand. But we put this up on our Excel sheets, that credit is where we will end up making money. But overall, I guess to come around your question from the revenue stream perspective and the Excel sheets, which all of us would have done a number of times, I guess software services, initial first few hooks where you get the customer base done. The real monetization hooks in this segment, which have started to show up for us, of course, credit, wherein you need to solve for cost of capital, disbursement, and the biggest cost being the collection, and the money comes back and the NPAs are low. The next hook that we are trying right now is insurance, which has to be again very contextual and very related to trade, right? So given, again, I'm going back to example what we do today. So on one side, on the SME's house, we are connected to the ERP of the SME. On the other side, we connect into his current account, which essentially means every time there is an invoice that happens, a purchase order that happens, I have my eyes on it. So with the invoice lending to him, most likely goods are going to come through. I can trigger warehouse insurance or inventory insurance. There is an invoice he has created and he's shipping it out, and there is an e-way bill which gets done through me. I know this guy is going to prepare a truck. So should it be a transit insurance which should be flashed to him? So I guess all of these are the problem statements today wherein, and I can tell you from our experience, I mean, even the transit insurance was a use case wherein one of the days I noted on the platform there is an invoice which is created today, but its e-way bill was generated 4 days later, and that is when the truck literally moved. I called up the fellow entrepreneur on the other side, someone in steel business, just to learn that this guy had sent the boys out to get the truck insured because this truck is 38 lakh rupees of worth of goods, right? So now the same thing, if it could happen for him on a click of a button or a link went out, the guy would happily pay you 100 rupees for the service and something else on top of that that we get from the company side. But I guess monetization wise, if you're looking at India as we speak today, payments, no monetization. Software, no monetization. By the time you get to lending, you have to be in the play for good few 4 or 5 years so that you have enough data and base. And then you can continue to build, and your story could be cross-border and cross-border finance, cross-border payments and stuff. This is my playbook that I'm playing today wherein I would monetize further.
I have a slightly different take on Vishal's answer, and then maybe we can take one last question directed at either Avisha or Anand. One of my favorite movies is The Founder, in which Ray Kroc goes around building McDonald's, and there's a time when his business is in trouble, even though he has a lot of new stores opening up. And somebody gives him this advice, and he says that you don't make an empire by taking a 10% cut of a 15% burger, right? You do it by owning the land that burger is cooked on. And I think what you're seeing in fintech is this move to higher spread, higher margin products, because it's better to earn interchange on cards than a trail commission on mutual funds, which is just about 50 bips. It's even better to get a 3% spread on dispersing a loan, and it's fantastic to get a 30% commission on distributing insurance, right? But I think what we need to realize here as well is that we're building consumer platforms that are bringing millions of people onto it, and we have granular data capabilities, right, that are more powerful than anything that Google or Facebook are operating off of, right? And I think that's the non-distribution source of revenue that I would be very keen to see emerge in India first. All right, let's take one last question.
Hi, myself Dharmesh. I'm from ICICI Bank. My question is basically, okay, so my question is basically, nowadays when we see the neo banking or the fintech companies, so it is just like a banking. They are providing each and everything. They are providing collection, they are providing payment, they are providing a trade, everything. So what do you think that after next 10 years, what will be the position of fintech in the market?
Well, I mean, see, at the end of the day, the customer belongs to the bank, right? Because the product and services are of the bank, right? You only enhance the experience of the various product and services that being offered through a fintech, right? So when I say the customer belongs to a bank, that means the core will always remain, right? The bank has to be there, right? And fintechs become more of a kind of a distribution channel, a distribution strategy, or create great customer experience. I think that's the whole thing what they're trying to do here. So bank going away, I don't think exists. I think banks are going to be there for sure. And fintechs are will obviously start working more. I mean, they're already working very closely with banks. And I'm sure they'll do much more. I think especially the play on technology, especially play on innovation is where fintech will start playing. But at the end of the day, customer belongs to the bank, right? So that's the whole truth.
Just to add to that, very interestingly, RBI in its working committee report on digital lending back in 2021 November, it had said exactly what you said, that neobanks are portraying or giving an impression to consumers as if they are in the banking business, and that needs to stop. And bank needs to make sure that the messaging to the consumers is correct. So this is more on, of course, the way that things are advertised, but the heart of the product still remains, and your question is still valid, that the heart of the product still remains the banking products, whether they be offered by the banks themselves or through a neobank entity. That definitely remains, but what I also see happening is as in more data gets generated through the coming years, there could be potential to use that data in a much more cross-sectional way. And perhaps, like Vishal said, maybe software doesn't itself sell, but with the amount of data that will be generated and the amount of prospect that it can come, there could be a time when banking is just one of the services that a neobank is providing, and the other services take precedence over the banking services. And those could be entities which are which look into the business of neobanking right now and don't want to go to a full stack digital business.
Last few words on the same point, Dharmesh, to your point. So I guess banking is something that, I mean, that's where I kind of earlier said neobank is something that I would shy away to call ourselves as. So we are a fintech. We are tech first, and we enable some fin at some point in time. And that's where we have spoken enough that we do some number of C's before we come to any C which is anywhere close to banking C. So to that point, I guess the role that possibly even 10 years from today I would see for businesses possibly that we are building is we would know the segment and the user a lot better and a lot deeper that bank will never get to. We will have use cases that we would have addressed in various flows which no bank will get to. But then for being able to deliver those banking services, as Avisha said, we will bring everything to you on the plate. I would still continue to, have this controversy around, would I call this guy my customer or bank's customer? I would pretty much call this guy as my customer because I'm solving tons of his problems and use cases. And for one of the service, I possibly take him to bank A. For another service, I take him to bank B, and third service possibly an NBFC. Because all said and done, even banks have their hands tied to serve all the products to a given segment that possibly I serve today. So I guess that's essentially a moonshot or a 10-year later roadmap that we see in this ecosystem, wherein this marriage should work very well. We just need to make sure that either side of the parties understand that as a fintech, I'm no banker and I can't do banking ever. Even if I hire bankers on my team, I will not become a bank. And likewise, on the banking side, there is great banking happening already, and tech and getting that sentiment wherein bankers will leave their AC room and go and sit in that Kirana store or the warehouse and understand those use cases possibly which the hustlers on this side do today. So we both have our own side of complementarity which would continue to stay.
Great. Just before we conclude, there are lots of different kinds of financial services out there in every category, provided by every kind of provider. But in this room, how many of us feel like we are good with money? Right? And I think that's why we're here and still have a role to play. All right. Thank you so much to all of our panelists and to our organizers for an engaging discussion, and to all of you for listening in.